Welcome. Today's webinar from SC Insights will be focusing on lithium batteries and trade wars. We're going to be discussing a little bit about some of the trends in electric vehicles and recent tariff barriers which are likely to go up in the EV sector. Then look a little bit at how that's impacting the costs and prices across the supply chain, before looking a little bit more detail at the lithium side of the market. For that, I'm joined by my colleague Jose Hofer, and we'll be looking both at the development of production costs and our view as to what's likely to happen in both the short and the long term for lithium prices. And as I say, please do feel free to jump in with questions as we go through. Quick recap, SC Insights, we are a specialist lithium-ion supply chain research and consultancy. We primarily work on asset level due diligence, looking at people who are looking to debt finance, primarily the mining space, the cathode, PCAM, cell production parts of the supply chain, where we have numerous models that we use to help forecast those markets. We also do a huge amount of term sheet advisory, very difficult in the supply chain to build anything without some kind of take or pay offtake contract. And again, we have a wealth of experience in negotiating and advising on those contracts. So if you're interested in that, please do feel free to reach out. And you can do that via scanning the QR code on the screen there, which will also be shown later. So to jump straight in, we've had a lot of negativity in the press, particularly outside of China recently, about where the EV transition is, what's happening to sales. We've seen the reduction of some subsidies, the pushback of some targets outside of China, and if anything, that's made the current market more reliant upon China. You can see from the chart here, you've got our view as to the millions of units and also the EV penetration level that we forecast over the next 20 years. So probably middle of the road forecast when you look at all of those out there. The one sort of change that we've had, we haven't changed our overall forecast for EVs and EV penetration, but we have seen a slowdown in North America, a slowdown in Europe, and a subsequent increase speeding up in China. Now, one of the issues that you have in this supply chain, and I refer here to the shaded areas in the background, is that for the first sort of 5 or 6 years of mass market EVs, the market was very much limited by supply. So effectively, if you produce an electric vehicle, you could sell them. And if you remember, you had the Tesla wait lists, you had pre-ordering was very common in the electric vehicle supply chain, whereas now you're moving to a situation where inventories are increasing, similar to the way that the internal combustion market works. And also you've got some units that aren't selling. So you're moving to a market where electric vehicle sales are largely limited by demand for electric vehicles and the quality and the price of those electric vehicles. And this sort of transition phase brings in a lot of uncertainty when it comes to investment in the supply chain. And we'll talk about some of the issues that's brought up in decision-making at Western OEMs, but also in cell and cathode and other supply chain producers, and also some of the role that the government can take in alleviating those concerns. On the far side, you've got the green shaded area, and that's effectively where a lot of the policy, the political mandate for the transition kicks in, where you've got full stops for price sales, or for production. Importantly, this is sort of when in the run up to 2025, when a lot of these targets kick in, even more so in 2040 and 2045. But those targets cover the vast majority of vehicle manufacturing and also the majority of vehicle sales as well. Now, the interesting part in the yellow highlighted shaded area there is what could potentially speed up or keep the EV transitional process. And this stems from a piece of work we did with a couple of OEMs, looking at whether EVs can actually get to a point where they outcompete internal combustion on consumer choice because they win on every major metric, where they win on sticker price, where they win on cost of ownership, which you could argue is already the case, performance of the vehicle, comfort of the vehicle, and even actually on the hassle of refilling versus the hassle of charging. Now, that will be very market specific. particularly when it comes to the charging infrastructure. But we're starting to see this happen in markets like China already, partly because of the wealth of models which have been introduced in that market and the cost point and price point that those are being sold at. So we think actually in the next generation of EVs, given the technological trends that are happening, given increases in energy density for the batteries, given the falling costs, you could actually get to a position towards the end of this decade where you see another big spurt in demand for electric vehicles just based on their performance. But as I say, it's a little bit of a sticky time at the moment, particularly outside of China. You've seen a lot of automotive manufacturers move towards plug-in hybrids, plug-in hybrids themselves, typically getting bigger packs, bigger pack sizes. We've seen quite a few PHEVs being launched with 30, 35, even 40 kilowatt hour packs, so really quite sizable batteries in them. I think for us though, it is still a bit of a stopgap technology. I wouldn't bet the barn on it because effectively you're carrying around two forms of transmission. You've got two different supply chains you need to support. And for us, it's still very much that adage of it's a bit of a steamship with sails. When we first brought in motorized power to sailing vessels, we still had sails on them because people didn't trust the new technology. I think that that will still be a transition technology for plug-in hybrids. And again, our view is that the fully electric way is something to look at. The other interesting thing, the trend that we have, which is probably slightly less bullish for automotive producers, is as we get towards the 2030s and through the 2030s, you potentially have a lot more self-driving vehicles, autonomous vehicles coming in. And what you're likely to see with them is the increase in the average utilization rate of vehicles in the private fleet. So when you get things like robo-taxis coming in, these are likely to be operating for a very large percentage of the time. That's not the case with current privately owned vehicles, which have average utilizations of 5 or 6%. So effectively, we could see a decline in the global fleet size, or at least not a large increase in the global fleet size. That will have less of an impact on electric vehicles than it will on plug-in hybrids and internal combustion, because it makes more economic sense for those autonomous vehicles to be fully electric. But just an overview there of some of the trends that we're seeing underlying the lithium-ion battery market. Transportation takes up in the future about 75% of lithium-ion battery demand. No longer the fastest growing sector in percentage terms. That's energy storage systems now. Portable electronics, not really seeing a huge increase. But really the driving factor for lithium demand and for obviously the batteries themselves remains the transportation sector. So some really important trends shown in that chart. Now, the other big issue that we are seeing at the moment is the oversupply and overcapacity of Chinese industry. And that's obviously been out competing traditional suppliers outside of China. And we'll look at that a little bit in the next chart. But obviously with the announcement last week of an increase in tariffs on Chinese vehicles coming into the US up to 100% from 25%, from lithium-ion batteries for the EV sector from 7.5% to 25%, and a similar increase, albeit from 2026, for batteries in the non-electric vehicle sector. And I think that from the US is a bit of an acceptance that really when you look at the energy storage market, and less so portable electronics, there's no other game in town than China at the moment. Almost all ESS batteries being deployed in the US at the moment are Chinese in origin. They don't have the same foreign entity of concern rules when it comes to the Inflation Reduction Act and subsidies and access to subsidies in the US, but that capacity just simply isn't there. And actually, if you look at the announced cell production capacity in the US, 90% of the announced capacity is already sold into the automotive market. So the North America in general has a mountain to climb still when it comes to battery investment to service the ESS sector. And potentially that increase from 2026 will spur some of the interest there. Another interesting point that we had from the announcement from the White House recently was the delay in foreign entity of concern, read China, rules when it comes to graphite supply into the supply chain. You know, China produces over 90% of most of the materials going into the anode supply chain. There are a number of projects in the US. Some of them are moving forward. Some of them have recently managed to announce offtakes, but they won't be up and running at scale until 2026 and probably a little bit after. So it's interesting that the government have actually taken what industry is saying into account. They can see that the investment's coming, and because of that, they're delaying the implementation of some of the tariffs and some of the barriers to raw materials coming into that part of the supply chain. Now, it's worth mentioning what Europe's response is here as well, because Europe has, in many respects, a much weaker hand to play. The US can effectively cut out Chinese investment in that country, and indeed it won't open up subsidies to Chinese companies. In a similar way, incidentally, China doesn't open up subsidies to foreign companies in its own economy, so it's reciprocal rather than being a unilateral decision that the US have made. And whereas in Europe, I think what we'll see is a lot of Chinese companies looking to invest in the supply chain in electric vehicle production. You know, we've had announcements from BYD. We're likely to see more investments from like CATL, Gotion, the big Chinese players, looking to build capacity in Europe for the European market, for the European export market. Makes sense. I don't think the EU would manage to ban that. You know, the Chinese, looking at these investments, can play 27 countries off of each other. You're not going to get a holistic European policy that knocks China out of the market, because effectively the only markets that you're protecting are, the German market, the Spanish, Italian, etc. And, that's not in Hungary's interest, it's not in Estonia's interest, etc. So you're not going to get that consistency of policy approach in Europe. It does mean that Europe might get more investment, particularly from the leading Chinese companies. But as I say, there'll be a bit of a divergence there, I think, in how North America and Europe react to this supply chain and react to the increase in Chinese exports. We do expect to see tariffs on Chinese vehicles being announced by the EU. The rumours are that they're likely to be around 30%, which is quite interesting, actually, because if you look at the additional cost of buying a Chinese electric vehicle in many European markets versus the cost in China, 30, sometimes even 40% is the increase that they have. So possibly China could still manage to compete even with a tariff at that level. But it would be interesting to see. I think that the choice from the European market is that they would prefer production done locally, whether that's Chinese or not. Whereas in the US, it's more, let's have local production by local companies. The Chinese industry, as we all know, is considerably larger, has more efficiencies, potentially better technologies being deployed at the moment. Since the pandemic, we have had a political view that we need to effectively avoid single points of failure. And governments are working to support that and effectively to build out industries outside of China. And there are a number of things that, we think that they can do to support that. The first one is when we're looking at some of the manufacturing, but in particular the extractive industries, the mines that are being built out, a lot of them suffer from legal challenges. Now, this is separate to permitting as an issue. Permitting is something that's important. It's a process you need to go through. It's a process that, while it can be very Byzantine, you do understand it's written into law, it's written into legislation. The issue then is you can quite often have a 6, 12, 24-month delay because of legal challenges, sometimes maybe even spurious legal challenges. Now, we're not saying that you should effectively stop all of those legal challenges. Some may well be with merit, but it is important to streamline that approach because it's creating a huge barrier to the implementation of of non-Chinese supply chains. Next one is obviously supporting the financing. We often complain about China financing its supply chains in new energy technologies, but it's something that we can do ourselves. The role of the US Loan Program Office, the role of the European Investment Bank, they do a lot. They can probably do more when it comes to creating access to debt capital. I think another important thing that governments can do is work to increase education for the general population when it comes to the extractive industries, and effectively look to increase the social license for these. We're not talking about forcing mining down people's throats, but we are talking about education so that people understand why we're moving in this direction, why we need these new sources of raw material. Another issue that I think we would like to see is, and one of the barriers to entry that we have for a lot of the companies that we work with when they're seeking finance, is the qualification process. While incredibly important, is very tedious, very laborious, and you often have to go through it 5 or 6 times with 5 or 6 potential suppliers. If you're a refinery and you change your raw material supply, you may need to go through qualification again. Particularly in the case of lithium, this can really be challenging for the financing of these operations. As more people consume more lithium, more companies qualify more materials, I think there is a role that governments can play in streamlining the qualification process, by effectively trying to set industry standards or helping industry set industry standards as to materials that are qualified. And then if you are an OEM or a battery cell producer and a material is qualified for somebody else, you can have a less stringent qualification process before you can source that material. It gives you more purchasing options, and it means that you're more likely to have new supply coming from locations where you want new supply to come from. Now, why are we doing this? We've spoken a lot about in previous webinars of oversupply in various parts of the Chinese value chain, particularly when it comes to cathode and cell production, anode production as well. And what that's seen is, not just declining Chinese cell prices, despite falling raw material prices. One of the key reasons is that they've effectively destroyed the margin that those companies make. They have an established industry, an incumbent industry that's in oversupply. And what that means is it can move from producing at a cost that would be similar to cost B, which takes into account the manufacturing, so the depreciation, capex, debt servicing, cost of land, etc. And they can just produce with zero gross margin at that cost, at their operating cost. Now, that's fine for them. That's the market working. But it doesn't address the regional imbalances, where if you're trying to make an investment and get that investment, effectively you can't do that competing with that short-term price or that operating cost. What you need is an incentive price to make it worthwhile making that investment, which means you need to take into account the depreciation of new projects, the capex, the cost of land, etc. And that's in some respect is what the import taxes or countervailing duties, which we're seeing announced in the US and Europe, are there to address. So I think we will see a continuation of those trade barriers, and they're incredibly important and actually justified if we want to see a supply chain continue to be built out in Europe and North America. This becomes even more important when we start looking at the LFP supply chain versus NCM. With ternary cathodes, which most Western automotives have already invested in the supply chains for, there was an economic reason to do that. They weren't necessarily the best investments they would make based on return on capital, but they were worthwhile. When you look at the even lower margins, which are available in LFP or LFPM type cells, it's a much harder decision for boardrooms to make, investing in those supply chains, which don't really make much money. And I think a lot of Western automotive manufacturers are looking at that and saying, well, you know what, for the entry model vehicles where we don't make as much margin on the final vehicle as we would with a premium ternary cathode based vehicle, we're just going to buy those cells, and we'll buy them from China or from Chinese suppliers who invest in our local market. So that's, again, something that we're seeing happening in the industry at the moment. Moving on to lithium, before I pass on to Jose, there's just the sort of 50,000-foot overview here as to what's happening. We need to add another 1 million tons of supply in the next 4.5, 5 years. Current prices are around $15,000 per ton for lithium carbonate. Over the past 5-year period, we added 500,000 tons. We added half that amount. And we did it at an average price which was double. Now, there's a lot of volatility in that price, but the average price and the amount that was earned by the industry was double the current price. So it just goes to highlight the challenge that we're at on the lithium side. And you could actually show similar charts for nickel, for graphite, for manganese, where we've seen very weak pricing of late. Most of those prices have now bottomed out, but they are challenging the investment case for a lot of those raw materials. And with that, Jose, I will pass on to you to talk a little bit about where new lithium supply is going to come from, and then some of the costs and some of the challenges there.
Absolutely. Thanks so much, Andy. Greetings to our entire loyal audience. Today we have a record audience as well. Good day to everyone. So going to the outlook of lithium supply, and starting as of today, 2024, it's worth to mention that as opposed to the past 10 years when lithium demand started to double every 2.5 years, for the next 10 years, the lithium market is starting to moderate a little bit, growing or doubling every 5 years as of today. So in what is today a market a little bit above the 1 million tons LCE, in 2028 is going to become around 2, and by mid next decade, 2033 to 2035, it's going to surpass the level of 4 million, which places, first of all, which in a first instance highlights the importance of developing and supporting the mining projects, refining projects, cathode manufacturing activity, cell production, and at the same time highlights the importance of lithium-ion battery recycling. We know that, and we have a very strong position about this, that to reach those 4 million units, it's impossible to do it with primary sources. And at the same time, in order to fulfill a supply of 1 million units of recycled lithium, secondary lithium, it's an endogamic function of what it has been mined with a delay. Obviously, it's impossible to reach those quantities without promoting, supporting, developing projects that usually mining projects take 10 to 15 years to get developed, transitioning early stages of exploration, pre-feasibility, preliminary economic assessment, raising of capital, definite feasibility, then ramping up, commissioning, and finally production is definitely not easy. Secondly, in our extensive demand and supply project database, we track more than 300 projects. There is an important share of projects that are unfinanced. And this is not only from the refining side of things, this comes from mining projects as well, which is represented by that green area on the left-hand side graph, which accounts for 30% of the future supply. And that is quite concerning. It is a bit scary as well. If we zoom in that green area and jump to the right-hand side of this slide, you can see that the number of projects that are involved in that group jumps up to 80 mining projects globally that are first of all need to be developed, and secondly it's their existence, and especially introduction to the market, is gonna have a lot to say in terms of price dynamics as well. We continue believing that the market, the fundamentals are strong, but with some caveats. Please, next slide, please, Derek. Okay, so this is one of the latest slides that we've been sharing with our loyal customers, which is the lithium tree. However, an updated version of the lithium tree that has changed quite a lot since the pandemic. Back a long time ago, it used to be quite easy to graph the fluxes in the lithium sector. Today, let me tell you that there is a little bit more of activity before the chemical market, since now the top there's obviously been a lot more competition outside the group of the top 6 lithium mining refining companies, such as SQM, Albemarle, LIB, and Ganfeng, and Allkem. And today there's a lot of attention on the intermediate lithium products, such as, for example, lithium chloride in Argentina is going to definitely move the needle. And from other parts of the globe, lithium sulfate, both coming from primary lithium, the calcination and leaching of hard rock, and as well the recycling of lithium-ion batteries. And that is extremely key because it places challenges on, first of all, the handling and the logistics of those materials, but most important of all, on pricing, because pricing, first of all, for battery materials tends to be concentrated in terms of clusters. The idea of a commodity battery material in the lithium is evaporating very easily. But now that we're going to develop a market that's more based on intermediate products with intermediate qualities, then obviously the effort is put on the commercial teams and the price reporting agency on how they deal with those qualifications and pricing of the material and contracting, obviously. This really differentiates from our competitors, the lithium tree. And as well, the methodology that we follow for cost design and cost estimation in the entire industry is important to mention that as opposed to a top level approach, we actually do the contrary. We go into a bottom up approach where we focus on the technology, and depending on the project that we are dealing with, we tend to expand the knowledge, basically analyzing and performing the specific due diligence on a certain limited amount of projects. It's well known that the majority of the cost curves in the market are quite wrong, they are quite biased. But this actually bridges the conversation to our next slide, Derek. If you're still awake, this is the cost curve and the source of material from now till 2035. And a couple of highlights that we can mention here is that obviously on the left-hand side, you can see the source of material. This is mine material, including the secondary lithium, the recycling of lithium-ion batteries. The first highlight is that there's an enormous amount of material coming from hard rock, and not only spodumene. In fact, from the list, the extensive list of projects that we keep in our domains, there are even projects that aren't classified yet, and some of them include petalite, lepidolite, mica, and clays as well at the same time. And moving to the right-hand side, obviously we need to show the cost curve, but here is an important message to the audience and for the entire lithium industry as well, which has to do primarily with the consistency of the supply of lepidolite. And let me be very clear here that we don't share the approach of other consulting companies, such as, for example, the Goldman Sachs on the industry. We believe that the incentives for lepidolite, for example, are quite intermediate. And even if we go to the extreme case of African concentrate, where adding up to 50,000 metric tons LCE back in correct me if I'm wrong, Andy, 2021, 2022, the economics become even harder to sustain in order to have a long-term stable supply. This is one of the myths that we believe are quite weak in the industry. Yeah? The myth.
Yeah, and I'll just jump in and add on that. I think one of the reasons we've been relatively cautious on a lot of the lepidolite story, and it's worth separating, different sources of lepidolite. You have, as we had on a previous slide, these relatively industrialized large-scale mines, which, while high cost, can produce and break even at today's prices. You then have a lot more sort of lower grade ores, a lot of tailings projects that are a bit less economically viable. And I think increasingly, we see that as swing supply to the market. We don't see it as all coming on. We don't see the announced supply in China coming on. That doesn't make the cut in our forecasts in the spreadsheet. And the reason for that is simply that there's enough supply elsewhere. When we add up all of the projects that we have, there's about 370 odd in our lithium extraction database. You almost got enough lithium for the energy transition there. Not all of those projects will happen. There'll still be projects that yet to be discovered or announced that will come into the market and be very successful. But we know there's no geological shortage in the market. And indeed, we've discovered most of what we need. So that gives you then a competition as to what gets built, not having to build everything. And if you're a refiner, and we talk to a lot of the Chinese refineries on a regular basis, and you have a choice of what to refine, it's not going to be the low-grade direct shipping or something thrown on the back of a truck and shipped out at 1.2% lithium content. It's going to be the higher grade material. It's a lot easier to process spodumene than it is lepidolite for a lot of these refineries, and it's cheaper for them to process that material as well. So given the choice, and we believe there will be a choice, with swing supply coming in from these higher cost sources when the market goes into deficit, our view is very much that the more conventional brines, hard rock sources, and then also DLE will be the winners in the market over the long term.
If we could jump to the next one. Well, let me start briefly mentioning another myth that we believe that is important to shed some light, and that is the direct lithium extraction at the same time. You could link this slide with the lithium diagram and see the dynamics, the production, and how it will be developed. It's important to mention that not all the DLEs are created equally. I'm stealing that phrase from another consultant, but it's important to mention that some of them are commercialized, some of them are likely to be expanded further, but there is a lot of competition and development at the moment, especially in the subsections such as ionic exchange, solvent extraction, and especially membranes. Secondly, if we zoom in the quantities that we are tracking and the quantities that have been put on the market, we quickly realize that yes, it's type of a breakthrough technology, but the quantities aren't there. It's not that impressive as people think it could end up being. Yes, it is a complementary technology. It definitely speeds up the conventional concentration process, and obviously you end up with a high lithium chloride that could be carbonated or could be subject to an electrolysis further processing. But then again, the quantities are not there. And just to go to a quick example, for example, in the Chilean lithium industry, where the entire industry relied a little bit on the service of DLE providers. The government, the Chilean lithium industry is driven by the government. They realize that the majority of the DLEs are still in piloting, they're still in development, and most important of all, not all of them are financed, and that is an important aspect to take into consideration.
And as Jose mentions, there are a number of challenges in bringing these projects to market, whether it be from the commercial side, from the technical side, from the financing side, etc. And that's one of the reasons actually that we've recently launched a new service here at SC Insights, which, a bit of a plug here, is directly aimed at junior developers, those without an existing resource, both on the refining side and on the extraction side of the market, whether that be DLE or hard rock. And effectively what we do in this service is we provide a number of things which solve a number of use cases at those companies, whether that's providing advice on commercial offtake structures, it could be for sourcing your raw material, it could be for tolling agreements, it could be for selling the raw materials and offtakes, whether that be with an OEM, a cell manufacturer or trading group. So if you need advice there, do come to us as part of this service. Likewise, we have bankable price forecasts following standard industry methodologies, looking at supply and demand, looking at cost curves, etc., as we've already shown. Very good at putting individual projects on our cost curves so you can see the position that you will be in, and feeding that information into financial modeling. Likewise, we're quite happy for this information to be used in investor and marketing literature. So if you are interested in that, please do feel free to reach out to my colleagues on the QR code, which we'll show again at the end of the presentation. We've got a couple more slides to go as we look at the lithium price outlook and then a summation of what we've been speaking about today. Please do use the Q&A function. There will be a Q&A session in a few minutes' time. I can see we've got quite a few questions there, but please do feel free to register some more. Jose, I'll pass this one back to you, but then I'd also like to comment a little bit on it.
Sure, absolutely. Let me briefly comment on this very key slides, one of the best ones in this presentation. That's important to notice is that among our methodologies, we pay a lot of attention on inventories. And inventories is a quite useful metrics in order to start getting the feeling of the market and obviously where the prices is going. If we start studying the last two cycles, that is the 2015 till 2019 and then the 2020 till 2023, it's quite obvious that the level of inventories, at least we're predicting, or the decrease in the levels of inventories, we're predicting a price spike. And this is not only being said by the consultants. This is a metric that the lithium companies pay a lot of attention to. In the case of the first price cycle that we're showing over there, it was quite dramatic in terms of back then the long-term price incentives, which were around $6,000 per metric ton. In the inventories back in 2017, they even went below the 1 month of demand. Important to mention is that the healthy levels are typically around the 3 months of inventory. Some of the companies in 2017 ended up with close to zero inventory. So that's why the price, basically spot price, Chinese, jumped to the high 20s level. Lesson learned on the past cycle, the majority of the lithium mining integrated refining companies kept a healthy level of inventory. Nevertheless, the demand surprisingly it hit the market especially in 2021 and 2022, dropping the inventories even below the normal 2 months of inventory, the 60 days of inventory with a consequent price spike again. The last cycle that started in this year, 2020, 2024, we actually don't know how volatile it's going to be, nor the length, but we assume that the dynamics, well, obviously we're keeping track of the inventories. It could bring a couple of surprises before the end of the decade.
Yeah, and just to add here a little bit on the methodologies, typically what you would see when available inventory to purchase gets below that sort of 30-day level is price spikes in an industry. It doesn't always work exactly like that, and inventory data is also imperfect. But this gives a really good idea of just how tight the lithium market is. When you consider that, copper inventories are in some markets near all-time highs, yet prices are also at all-time highs. You can see that inventory plays a huge role. In the lithium market, we know that there aren't significant inventories. This operates very differently to commodity markets. You also don't have interchangeability of lithium chemicals, particularly those qualified for battery grade. And that's why we often talk about lithium being a specialty chemical rather than a pure commodity market. I think what is important to say is that, even though we, as with others, forecast a surplus over the next couple of years based on supply and cost analysis, it's likely that you will still have stocking and destocking cycles which impact throughout the course of a year, whether in surplus or deficit. And that should still lead to some price volatility in the market. It's also worth pointing out that, the percentage of the market, because this should be offset against the very growing market in the background, the percentage of the market supply that those surpluses represent gets smaller and smaller, to the point where you're looking at 0.4% of the market is the surplus. That's absolutely tiny. Any kind of demand side shock on the upside, and as I spoke to a bit earlier on that yellow period, we might see that from just consumer demand at some point could easily push this market into surplus. So it's really important to keep an eye on lithium, because I think it is going to be a pretty volatile ride. Finally, here to talk a little bit about the price forecast and then go on to some conclusions. Jose, do you want to have a go at this one first?
No, I'll let the controversial one to you. Right?
Okay. So this is one of the scenarios that we forecast. I think it came up with the highest possibility on some recent work that we did. I wouldn't worry too much about the price forecast itself. If you go back to the inventory slide, you can see that based on this scenario, we do see a squeeze in the market towards the end of the decade, and that's where the corresponding price peak comes in. The important thing to realise, and where we have more certainty in the forecast, is again in these bands. You can see that I enjoyed making my little coloured bands when I was making this presentation. The most important one there is, the death trap at the bottom in red. This industry, to be able to double the amount of supply that it needs, can't have prices much lower than they are today. It will be very difficult to meet the supply forecast and the demand levels that we need with current pricing. We do expect them to rise based on that. And I think, if we do get to these levels or go even lower for some reason, you're really going to see a huge struggle and probably an even greater price spike down the line. For us, the sort of Goldilocks zone where, almost all projects are incentivized, they're going to make a reasonable return on capital consummate with the risk of investing in these projects, is in that sort of 20,000-25,000 ton zone on a lithium carbonate basis. And then when we get to higher price levels where you're looking at super profits for incumbent producers, you start getting those higher cost forms of supply, lower grade lithium ores or higher grade lithium ores, which are harder to, more expensive to process, and so some of the more artisanal supply, tailings projects, etc., or tantalum tailings coming into the market. That should limit any long-term super, price spike, to a matter of under a year, I think, before you see a supply response. That predicated, however, on the assumption that there's enough refining capacity. If there isn't enough refining capacity, then you would need to build both the extraction and the refining capacity, and that could keep me in a cycle where you have higher prices for longer. But at the moment, again, on our forecast, we think at least to the end of the decade, there will be ample refining capacity. There is at the moment in China, and there are a lot of projects, coming on stream in Europe and North America as well, to increase that available refining capacity. So the shortage and the tightness, again, likely to be on the extraction rather than refining in our base case here. Just before we go into the Q&A, to summarize, I think we forecast this in our last lithium webinar, and indeed it's happened. It was a very difficult forecast that lithium prices have stabilized and seen modest increases on some restocking. There's more upside than downside risk to lithium prices over the next 6 months, in our view. That said, the market is still in oversupply. If you want to buy lithium units, you can buy lithium units. It's difficult to get prices going substantially higher when you can still say that sentence. As I say, price gains likely to be kicked by available raw material and the fact that we have ample refining supply. Longer term, the trends are still there. If you think about the two defining trends at the moment, you've got the energy transition and you've got artificial intelligence. Both of those require a big increase in electrification, a big increase in power demand. That's not just bullish for the copper market. It also means we're going to need a lot more energy storage. We're going to need a lot more lithium-ion batteries as the winning technology for at least short-term energy storage. So I think the underlying fundamentals still remain robust despite a quite negative sort of media cycle at the moment. Oversupply and weak margins in the middle of the supply chain, don't see that going away anytime soon. Very much, cathode, anode, cell producers pushed into cost plus type situations. We think they're going to be relatively weak markets that are oversupplied, probably until the end of the decade. And again, I think it's up to the non-Chinese supply chain to make sure they've got the right encouragements and subsidies and support if they don't want to rely on one country as a single point of failure. Raw material price declines, just finally on this one, we think they've largely run their course across the key battery raw materials, whether that be nickel, cobalt, lithium, graphite, manganese. Raw materials are making up a much greater share of battery prices now than they were even a year ago because of the decline in battery prices. I think what you'll see next year is probably an increase in average battery prices, even though the technologies are coming in. We're seeing more silicon in the anode. We're moving closer to commercial deployment of solid state. On a global average, probably raw material cost pass-through will cause cost push inflation on batteries next year. So with that, we're going to move to some of the questions. I don't think we'll have time to get through all of them, but we will try. So the first one here, if Chinese cell manufacturers sell outside of China and ship to the USA, will there be any restrictions going forward from the US government? Yes, and there already are. The tariffs are increasing from 7.5% to 25% for the EV sector, going up to 25% from 2026 in the non-EV sector. That one, I think, for me, is a bit more controversial because it may end up just being a tax on US consumers of batteries and things like the energy storage sector. So possible we'll see a change there if we don't get enough announced investment and supply coming from non-Chinese sources for the ESS market in the US. Next one, your lithium supply chart implies that all existing operations will continue to operate at the same capacity through 2040. Is this realistic when assets are depleting? Good question. A couple of points there. So the existing expansions, the existing category there does include some brownfield expansions. We do have some operations that are closing, but it's also worth bearing in mind that the vast majority of lithium operations have actually only started in the last 4 years. So are relatively early in their life of mine or life of brine, to coin a phrase. Is there anything to add on that one about potential depletion of resources?
Well, as you mentioned, the majority of them are quite new. Some of the assets that entered during 2017, 2018 are candidates to go out of business. But the main ones, the historic ones, there is a lot of potential to explore still. Take, for example, all the all the work that is being done on the LE to improve efficiencies, on leaching of existing stockpiles, on new areas that are yet to be used for production, etc.
Then what are your views on the potential impacts of Indonesian supply on global lithium markets and prices now that exploration is underway and there are potential resources being discovered there? Now, Indonesia normally gets mentioned in the context of nickel, cobalt and copper. I think it's just become the second biggest copper supplier, biggest nickel supplier, and large portions of cobalt now coming from there, although DRC still trumps it on that supply. You know, if they've got lithium as well, it sort of puts them in the perfect position. I don't think the assets that I have seen in Indonesia are really going to move the needle in terms of the supply-demand balance. What it will do is potentially see the Indonesian government are able to attract even more investment to become another sort of Asian powerhouse, along with Korea, Japan, and China on the battery side of the market by having these integrated supply chains. Historically, the Indonesian government has not been shy from forcing people into value-add investments with some success, some failure. So it's quite likely that they will use that lithium and then say, look, you know, we're going to tax you if you export it, or we're going to give you a subsidy if you want to put it into a cathode or a battery that's produced here. Jose, next question, I'm going to give an answer and then I'll hand it over to you. Because what is the expected cost of DLE projects? Around $5,000 per tonne or $9,000 per tonne, referring to one of the charts. But my answer to that is my expected cost of DLE projects on an operating cost basis is between $5,000 and $50,000 per tonne. You know, some of these projects won't work, and we won't know till they get to commercial scale, and it's a big risk. And I think that's why when we look at financing of DLE projects at the moment, a lot of them, if they can't self-finance, are having to basically build pretty big pilot level plants, you know, bigger than you would normally have for a pilot plant, just to prove the technology can work at scale. Jose, any comment there on DLE costs?
Yeah, just to mention, to finish this question, is that we foresee a difference in the cost, the operational cost in the LE. Well, depending obviously if it is a conventional brine asset that will be developed simultaneously with DLE, such as an Argentinian asset, we assume that it's going to be less costly than, for example, a geothermal asset. The reason behind that is concentration on one hand in the structure of the entire C1 OpEx.
Yeah, there's a question. What drives the jump of C3 costs in your cost curve, going from that sort of, you know, sub 10,000 to over 15,000 mark? There's a noticeable jump up in the cost curve there. Jose, I don't know if you want to take that one. If not, I'm happy to.
Yeah, briefly, just to shed some light, it's mainly well, there's no reason why the cost curve needs to be homogeneous. First of all, it depends on obviously the difficulties to mine. On high cost on the right hand side, we obviously have a lot of material from lepidolite. That's one thing, one of the factors. The other one is the African assets that can be either spodumene, lepidolite, or even ore.
Then how do we see new projects coming from the lithium triangle countries, Bolivia, Chile, and Argentina?
Yeah, let me take that one. We put a lot of effort in monitoring the lithium triangle, especially on the Argentinian side, because the last couple of editions of our forecast and our database have seen a lot of changes. And on the Argentinian side, if I remember correctly, we counted, we mentioned 8 projects that might enter between now and 2027-28, which is a miracle in the lithium industry. And then from 2028 till 2035, at least 20 more. So the majority of the dynamism and the changes are coming from Argentina. Bolivia and Chile, finally, they suffer from the same disease, which is the high control of the government, and especially Chile, where there's no concessibility, there's no mining granting of permitting to develop the industry, and Chile is basically 10 years behind Argentina in the lithium sector. I've given a lot of interviews. If you read Spanish, you're going to enjoy quite a lot. So.
How do we determine inventory levels in the market? Which sources do you find accurate and reliable? I'm yet to find a holistic source of lithium inventories, particularly across the supply chain, that is accurate or gives any kind of predicting power. We typically do it by survey of parts of the market. So it's just basically based on our networks of contacts in the supply chain. And that's, to date, more accurate than anything else I found. Hopefully there will be more transparency in the market going forward. But as I say, everything else we've checked just gives us useless information. On slide 13, inventories seem to increase after 2030 when we expect the market to enter deficit. Can you explain? I think the deficit we've actually got is 28, 29, which is when we've got the prices spiking, then the market going into surplus, which explains the increase in inventories. By the time we get to 2030, I would add the sort of certainty around the forecast really drops off a cliff. And that's because you've got, 200 odd projects which could come on by then. And we don't know who the winners and losers are going to be, but there are a huge number of projects which will, around that time, either shut down or get built. So yeah, something that you need to constantly look at. And can you speak to what lithium project development and exploration is going on inside of China, outside of lepidolite? Are there some producing spodumene operations and DLE EVAP brine in Shanghai and further east? Just to paraphrase, what's our view, Jose, on Chinese production levels and market share and technology routes?
Oh, that's a difficult question. We would need an entire new webinar for answering that. Huh?
There are.
Yeah.
I mean, I think just at a high level, we don't see Chinese extraction supply going above 15% of market share. As North America looks to onshore the lithium-ion battery supply chain, will the majority of lithium and CAM, with the majority of lithium and CAM produced in China, what are the options for midstream operations in this market? I mean, to be honest, there's plenty of opportunity for North America to move away from China when it comes to cathode active materials. The bigger concern is not actually China as a country, it's China owning resources outside of China. And where it has over 25%, it then comes under the foreign entity of concern rules, which is a big issue. So if you look at Indonesian nickel, if you look at a lot of the lithium operations around the world, they have Chinese investment, which should preclude them from some of the US subsidies. So I think that's probably the bigger issue when it comes to North America, that and the anode side of the market, which I'm just going to skip a question here because it brings me nicely onto what is your outlook for graphite. Recognize we're focusing more on lithium here, but graphite prices at the moment in the only market with any liquidity, which is China, are too low to incentivize production outside of China. And I think, the industry is sort of coming to see that that's the case, but they want supply from outside of China. They need it for some of the subsidies, and they're willing to pay a higher price for that. And graphite's probably the first one of the critical minerals, perhaps with the exception of rare earths, where we've seen people saying, look, okay, so much do I need this supply not coming from one source, I'm going to guarantee a higher price. And that's why you've seen some of these offtakes from the OEMs in the graphite sector recently.
There is one important question before we finish there on recycling. What do you expect to become the dominant intermediate from lithium recycling process? Lithium carbonate, sulfate, or phosphate? That's a spot on question. And obviously, as usual, it depends. For the recycler, it makes more sense to be producing lithium sulfate, so they can skip basically the carbonation process and obviously moving a lot of soda ash in order to do the bicarb. But for the refiner, it's difficult, especially when you are dealing or being offered with sulfate in solution, which happens to be the case most of the time. Same as with lithium chloride, moving and transporting a huge amount of liquid makes absolutely no sense. In the case of lithium sulfate in solution, it makes no sense in terms of logistics either.
Okay, I'm going to call it there. Unfortunately, we couldn't get through all of the questions. For those of you who put them in not anonymously, we will get back to you after the webinar. But thank you, everybody, for joining in and listening. And with that, we shall end. Thank you.
Total.